Hey guys, I'm Matt Atwood here, a CFP at Timewise Financial. And with everything going on this week, I wanted to take a moment to just touch base and talk about a few of the key components of what people are talking about in the news right now. We're starting to hear the R word or recession be thrown around. And we want to discuss, what is a recession, how it might affect you, and what's going on in the stock market. So without further ado, let's jump right in. So firstly, what is a recession? So many of us think when the stock market's down, we're in a recession. Well, the stock market has nothing to do with what a technical recession is. A recession is when we have 2 consecutive quarters of negative GDP or negative economic activity in the US. The stock market could be up, it could be flat, it could be slightly down. And that has nothing to do with whether we're entering a recession or not. All that matters is, has GDP went up or went down? Now, typically when we see GDP going down, we see some signs along the way. Unemployment starts to tick up. People start buying less. Businesses start to go bankrupt. People start getting kicked out of their houses, and young people can't find a good job. But we're in a weird cycle right now where none of these things are happening. Unemployment's at all-time lows. People are buying stuff still quite, and at a higher rate than they were last year. Businesses aren't teetering upon bankruptcy. People aren't getting kicked out of their houses, and there's 2 jobs available for every unemployed person. So why are we still at risk of entering a recession? Well, we said a recession was 2 consecutive quarters of negative GDP. And here's GDP, and there's actually different aspects or components that get calculated into GDP. One being consumption. When you go buy something at the store, that contributes to GDP. 2 being investment. When you add money into the stock market, that's increasing GDP. A big factor is trade. When countries buy stuff from us, that's a huge part of GDP. And the last part is government spending. When they buy planes from Lockheed Martin, they're contributing to GDP. And so we see last quarter, GDP ended up negative, but consumption and investment were actually positive. That big yellow bar is trade. It went down like crazy though. Why were countries not wanting to buy as much stuff from us, pushing GDP to be negative? Well, the value of a dollar relative to international currencies is actually going up. It's taking more euros to buy dollars than it was, let's say, a year ago. And there's a few factors for that. One part of that is, our currencies, inflating a bit so far this year. Another factor of that is we have the most historically stable stock market in the world. And so when there's Russian invaders knocking at your neighbor's door and you're living in, let's say, Poland, there's a strong incentive for you to exit your home economy and buy into a more stable economy. Convert your euros to dollars. Dollars are in favor right now. They're a stable currency historically, and you can see some historically unstable currencies, even like Bitcoin, really taking it on the chin right now as people exit those risky currencies and jump into a stable currency, all pushing up the value of our dollar relative to other countries. And so the red line at the same time is how many euros it takes to get a dollar. And you can see it's taking, relative to the value of the dollar, the euro is actually decreasing. It's going down. It's taking more euros to buy stuff here in America. It's more expensive to do trade here with us in the US for the factors we just covered. And so if trade's down, like we saw, that pushes the whole economy down. We could still be buying plenty of things and investing at a great level, but if people want to buy less from us, we could potentially get pushed into a recession. And so we'll find out in early July, how trade was affected this most recent quarter, and if we're going to enter a technical recession. But the traditional items that we're worried about that really are cause for concern in a recession aren't present right now. So our argument is maybe we shouldn't worry as much about this recession as we have in the past, because it's more of an international currency issue that will settle out over time than it is a sick economy. That being said, we do have inflation at the moment. This blue line's inflation, and you can see, ever since last year, it started going up quite sharply. We're around 8.5% right now. And we have to ask ourselves why. Why is inflation so high? And a big part of it, is people are spending money at a higher level than they were the year before. But there's one factor that's actually made everything in the economy much more expensive, and it's input into almost every single industry. And we compare that factor to just overall inflation, we start to get a picture of why everything's so much more expensive. And that's gas. So this red line, inflation's up 8.5%. This red line, gas, is up 62% year over year, meaning gas prices have went up much more drastically than overall inflation. And so our argument is, while we're pulling some great levers along the way by raising interest rates and quitting the money printer, turning off the money printer, we got to get control of gas prices first before we can really stifle inflation. So it is a good thing, the factors that the Fed have taken advantage of so far this year, because last year, all of clients were saying, hey, I think we need to quit printing money, and I think we need to cool down everything inflating so quickly. We need to take some action. And we're doing exactly that. The Fed has turned off the money printers, and they are making money more expensive to borrow, meaning people are going to spend a little less. They're reducing demand so supply can catch up. But another factor we got to get a hold of in the near future is gas prices, if we really want to stifle this inflation. But there's already factors at play. As gas stays at $5.50 a gallon, less and less people are going to want to get in line to buy gas. Demand starts to shut off, and that's going to help soften prices over the next few months. That being said, let's talk about these rate hikes. We had the largest rate hike in 28 years just yesterday, at the time of recording. And what this is doing is to help cool the economy. If we just left free money running in the economy in perpetuity, then a bubble would appear. And that's when people really take it on the chin. And so it's a great thing the Fed is doing to make money more expensive to borrow, because what that's going to do is cool down the amount of people who want to buy houses, cool down the amount of people who want to buy cars, so that auto manufacturers and home manufacturers can catch up. Otherwise, if we just let it run out of control, that's when we see sharp pullbacks like we saw in 08. There are going to be some hiccups along the way, though. When you start to make money more expensive to borrow, companies start to wonder, how much are people going to spend on other categories? And the stock market is trying to figure that out at this moment. That's why it's went down so far this year. But we know that consumers and investors tend to overreact. They tend to get too worried when times are okay and too excited when times are just all right. And so when we look at consumer confidence, it's hitting all-time lows. What this means, though, is there's actually a silver lining here. When people are overexcited, the next 12 months in the stock market typically aren't all that great. But when people start to get overly scared, they usually overreact, like we see. And the next 12 months actually are really great for the stock market. We see more than double-digit returns essentially every time consumer sentiment hits all-time lows. So if history is any indication, the next 12 months should actually be a great cycle for the overall stock market, even though we've had some hiccups along the way. So if you see your peers and it looks like they're running over a distant hill up ahead, first check and see it very might be a cliff. And we don't want you jumping off the cliff with all the other individual investors. So it's important to remember that if you're a client of ours, you've got a diverse set of investments that isn't on the hook for the full roller coaster ride. And you got us, a team that we encourage you guys to lean on, because it's very easy to let emotions drive decisions at times like this, when the news is just doom and gloom. But if you have any concerns or you're worried, give us a call. We are an independent third party who watches this stuff regularly, who can give you a broader or help you take a step back and add perspective before you make a rash decision. So that being said, I appreciate you taking the time to watch along with us. If this video drove any questions, hit the comments or give us a shout. And otherwise, we'll keep in touch as we continue to navigate these volatile times. And thanks for watching.